Okay, good afternoon.
Good afternoon, Commissioner Funa.
Yes. Can I ask the IC officials to please turn on your cameras? Art and Milo and all the rest. Okay, so good to see everyone.
Good afternoon.
Please go ahead.
Okay, so thank you everyone for gathering together this afternoon. What wonderful technology this used to be. 12 months ago, Zoom and Teams were such a fantastic tool, and now it seems a little bit inadequate, but I hope that everyone can hear me and we'll be able to conduct our business this afternoon. So let me start actually just by introducing my partner, Jeff Atwood. Jeff, do you just want to say hi quickly? Make sure you're all connected up. Okay.
Yes, good afternoon.
Okay. All right. So I think I'll keep the introductions quite short. And if I may, I'm going to attempt to share my screen, and we can go through the presentation that I intended. I did send a copy previously, but let me see if I can get into the main presentation here. I'm not used to Zoom. Okay, can you just confirm, or somebody can confirm that they can see my screen?
I can see it, Stuart.
Okay. Good. All right.
Yeah,
I'll see.
we see it.
Okay, good. Oh, that's fantastic. Okay, so I can say just up front that the purpose of our endeavour, what we are asking you to do, is to consider securitisation for the insurance industry. And the reason for that is that we want to create asset-backed securities based on infrastructure assets. So these would be effectively trade receivables, which will then be securitized and sold to the insurance industry. That is our task at hand, to convince you that that is the correct course of action. So I'm just going to go ahead and start the presentation.
If I may, Stuart, just for a while, Art and Milo, did I forward to you their materials which they sent?
Yes, we have their materials.
It's video. Okay. So I will be. So please study this under ISD TSG, under Art, and
Yes,
please
sir.
furnish us with your recommendations. And you may consult Bob Florendo and Nadia Escolango on legal matters on this. So sorry for that, Stuart. So please go ahead.
Okay, very good. Thank you very much. Okay, so just a very brief background and recital. Lantern Capital was formed up this year. So we're a newly minted Filipino corporation, although clearly the main protagonists of the organisation are myself and my partner Jeff, who are British nationals. But we have quite an interesting story, I think, to tell in terms of the infrastructure market, securitization, and how the insurance industry can participate. Our notion is that securitization of high quality infrastructure projects is the most efficient way to create liquidity in what is a very difficult market that is becoming more difficult as we go through the we realize the conditions that are brought upon us by this pandemic. What we wish to emphasize is that we believe that securitization reduces risk and it promotes competition. And it's also very good for the general marketplace, good for the consumer, but good for the insurance companies as well. So just going into the current conditions, what we're seeing is somewhat of a distortion in terms of the yields attached to government securities and treasuries. We think that is partially created by the excess liquidity that exists in the banking system. We know that the banks in the Philippines have, in recent years at least, maintained a high level of liquidity with very high capital adequacy ratios in the sort of 12 to even 16 percentile range. And they've been sheltering in government securities, which has been pushing the yields down. That's bad for the insurance asset portfolio managers. We know that the perception of risk in the economy is increasing, and the underwriting or the lending criteria is becoming stiffer and more difficult to attain from commercial lenders. And that's also causing a depression in yields. Now, in terms of the peso debt market, we also observe that it's a very short-term market, with the majority of securities being issued for less than 5 years, with very, very little being issued above that, and almost nothing above 10 years, with some notable exceptions, but they are the exception, not the rule. So in terms of the problem that we're facing, we're seeing that a lack of liquidity in the infrastructure refinancing is really stifling competition and is inhibiting growth. And that's happening just at the time where the focus on the infrastructure has never been greater, that the need to rebuild, regenerate and create new infrastructure has never been more important. But particularly for small to medium-sized infrastructure originators, and we're talking about people that are operating sort of less than $100 million in terms of their assets or the assets that they're trying to build, that they run out of balance sheet space. They run out of space on their balance sheets very quickly, and that prevents growth. Now, I'm going to give two examples here. There are many others, but these two are very good examples, we think. The first is renewable energy, and the second is actually telecoms infrastructure, but we're focusing for this argument just on cell towers. Now, in renewable energy, the National Renewable Energy Plan is calling for over a third of the country's energy to be produced from renewable sources by 2030. Now, when that plan was conceived, 2030 seemed like a reasonably long time away, but that's just around the corner in terms of infrastructure project development. That target alone is calling for about $2 billion a year of new infrastructure investment for the next 10 years. And that's at today's target. We know that going forward, those targets are going to be more generous in terms of the proportion for renewable energy. What we also know is that small to medium-sized originators need access to securitization in order to recycle their capital. Now, if we take, for example, some of the very large infrastructure operators, for which there are, if you like, the usual suspects in the Philippines, the likes of maybe the Ayala Group or San Miguel, they've got multiple choices in terms of raising capital. They can go to the bond market, they can do rights issues. There's lots of things that they can do. For smaller developers, for which the market depends, those options don't exist. So securitization provides them an extremely effective way to recycle capital. And of course, that's what asset-backed securities is all about. It's about capital recycling. In the telecoms sector, the DICT has this kind of notion of 50,000 new cell towers in the country. That seems like a very high target and not one that's really being properly tackled, even with the market liberalisation that's taking place. But let's just say that 25,000 of those towers are erected over the next 5 years, well, that's about an extra $2.5 billion worth of investment at a time where the banks are frankly not willing to go into those new investments. So this has a big knock-on effect for the whole economy. The local institutions have demonstrated, that they're very reluctant in this area. But this is an example of where securitization would allow the balance sheet to be used again and again in order to recycle, to build infrastructure. Okay, so the objective, our objective, is to unlock capital from the insurance sector. And the sort of narrative here is that, whilst the banks maintain a grip on infrastructure lending, on commercial lending, and whilst they feel that this is a difficult time and they're unable to sort of perform their task, in order for infrastructure to continue to grow, we've got to look for new sources. And that's why we want to go to the insurance sector to release some of their capital. Now, we know that the banks have declined, or their lending has declined, apparently up to 4%, up to May of this year, and that the banks are reluctant to refinance highly collateralized projects. In other words, the projects that they like, they'll finance and then they'll hold onto those loans, and that reduces capital velocity, which means that those small to medium-sized infrastructure developers are then stuck because it's extremely difficult for them to go ahead and continue to develop. What we want is for those people to have market access, to wider market access to capital, so that they can concentrate on building infrastructure. So by creating asset-backed securities, that's exactly what they can do. They can concentrate on doing what they do best, and they're not hamstrung by the domestic credit market. Now, we know that insurance fund managers also need access to long-term credit-rated securities to hedge against long-term liabilities, and there's many examples of that. We'll come on to some of them. So the problem is that government securities just don't work anymore in terms of a store of value in the portfolio. The insurance industry holds about 31, the private insurance industry holds about $31 billion worth of assets, and about a third of that is held in government securities. Now, I think that makes a lot of sense. We know a sort of traditional, set piece portfolio manager would require his portfolio to be split 1/3, 1/3, 1/3. But there's an additional risk now with these securities because they're not yielding anything, and that's no good to match long-term liabilities. The benchmark 10-year Treasury is producing less than 4%. I think it's about 3.85% right now in the aftermarket. And after tax and inflation, the real rate of return is less than 1%. Now, if we take, for example, the pensions reforms that are taking place, which are, in my opinion, long overdue, but a very good opportunity for the insurance industry to collect premiums and also acquire long-term liabilities, treasuries are not going to perform. They are effectively non-performing in the portfolio right now. Therefore, we maintain that asset-backed securities will provide a greater store of value over the long term, and that's what we want to promote. I'm just reinforcing the point here. Government securities are just not working. We know there's an interest rate risk, there's a duration risk. It's only very recently that government securities themselves have been issued for 10 or maybe 20 years, whereas in the asset-backed security field, we can start to look for infrastructure-based asset-backed securities that go to sort of 15 or 25 or even longer years in terms of their tenor, and will produce higher yields and in some cases index-linked higher yields. You can see the point that I'm trying to place here. Okay, now our target is to not obviously eliminate government securities from the portfolio, because we realise that there's a capital charge issue related here, but we think that there is an argument, a very strong argument right now, to say a proportion of those government securities could be migrated across into asset-backed securities. So how can the Commission help? Well, we believe that the first thing that could be done is to actually recognise securitisation as an admitted asset, which I believe is not the case right now. That would be a great start, and by creating reasonable credit-rated, moderately risked but higher yielding bonds, that it gives the portfolio manager more options, and by having those assets recognised by the Commission, it would help us sort of promote the market place here. But also particularly, we realise that the insurance market can purchase receivables right now. The idea with infrastructure bonds is that we're taking what could be a slightly risky or certainly a higher risk asset, but reducing that risk as much as possible by passing it through a securitised structure and then placing a credit rating on that asset. So we're trying to provide alternatives to government securities. Now, we know there's a lot of changes in the bond market right now. You know, some people are talking about growth. Some people are in the bond market are saying maybe some of that growth is quite temporary. You know, whilst we've got kind of restocking going on, so there's a bit of confusion. But certainly, I think when you look at the assets of insurance companies in the Philippines, there is scope for diversification. And we know there are better returns available. So in terms of the numbers, we think that if you were to convert 15% of the existing portfolio into asset-backed securities, you've got about $1.3 billion worth of new securities to be created. If we look at the public sector insurance market, just looking at GSIS, assuming a 5% conversion, I think their assets are about the same as the private sector. So you're looking at about $1.4 billion, and then possibly about the same amount from the open market, as people perhaps want to diversify away from equities over the next few years and pick up some of the slack in asset-backed securities. So that's it. I mean, our story is pretty straightforward. I think our message is very clear, and we're hoping that we can convince the Insurance Commission to offer its support. So I hope that was a pretty clear picture, and I'm open to the floor.
Thank you for that, Stuart. Before I ask Bong Florendo and maybe Art Trinidad and Amilo and Deputy Escolago for their views, can you email a copy of that presentation to me, Stuart?
Yes, of course I will.
I'll give you my email address. It's dennisfuna@yahoo.com. One word. Okay. dennisfuna@yahoo.com. And I will just distribute it to the other officers of the Insurance Commission.
Yes.
So, what's your view on this, Bong Florendo and maybe Art first? What's our current regulation on securitization? Art and Milo.
Com, if I may.
Yes, go ahead, Camilo.
So actually, Com, currently, in the regulations of the Insurance Commission, we don't have framework for ABS. So for the asset-backed securities, that's why they are asking for the support of IC to
We've never had this before. Is that what you're saying?
we don't have specific guidelines for asset-backed securities. However, there are some certain regulations that is aligned with their proposal, especially on the infrastructure investments. We have guidelines encouraging insurance companies to invest in renewable energy and telecom businesses under Circular Letter 2019. And also, we allowed insurance companies to invest in purchasing accounts receivable or loans receivable, similar to asset-backed securities. So by allowing this type of investment, maybe the insurance companies may gain additional yield to their investment portfolios that they are needed. But
What's the risk level when it comes to these investments?
Stuart?
Okay, so the risk level is rated according to the tranche that is created. So in an asset-backed security, you have what's called a waterfall cash flow, and we would be seeking investment grade or above credit ratings for the first tranche. They would be on a par with what is available from within the government securities market. So they would be highly rated in most cases. And also, I'd like to just mention that what we are looking at are very low risk underlying assets. So we're going into high quality infrastructure assets that have predictable long-term revenues, and we're staying away from sort of more complex structures like collateralized debt obligations or sort of contracts to sell. Although they are valid, what we wish to do in first instance for the next sort of 2 to 3 years is to create bespoke asset-backed securities based on high quality infrastructure that would have credit ratings of at least investment grade and up to AAA.
Bong, can we hear your thoughts on this? We are just making, looking at this preliminarily. Of course, this will be studied comprehensively by our TSG team, and we will probably have an exchange of views with the proponent at a later time. So, Bong?
On our end, I think securitization as an alternative option for investments is definitely a welcome opportunity, for IC to further boost up the returns of insurance companies. I think my only concern will be the challenges that we will be facing in determining the acceptability of the investment. I say this because number one, we have to look at the law, and again, I'll defer to DEPCOM Randy and DEPCOM Eric on this. With regards to the types of assets that an insurance company may invest in. Now, considering we are able to look at the provision that allows us to, allow securitization as an investment, the next challenge really is in the analysis of the investment itself. Because currently, under our regulation, all investments that are required of banks should be investment grade. That is rated by either Moody's and S&P or even the local rating agency. So I think until we are able to develop internal capability like NAIC in the US, where unrated paper can be analyzed by their finance analyst with respect to cash flows, the probability of default, payments, and whatnot. We cannot, provide an equivalent of the Moody's or the Philippine credit rating. Just to give you an example, the Power Sector Assets and Liabilities Management Corporation in 2007 or 2008 tried to securitize the 2 billion peso cash flow payments coming from the purchaser or the lessee of the Transco assets. We were trying to sell this to Union Bank. And even Union Bank at that time was wanting a government guarantee on the cash flows of Transco, considering that Transco is already the backbone of our, electricity grid. They are still wanting proof that, cash flows will continue. My point being, it is still the rating that investors will be looking at. And I don't know the appetite of our technical services group under the investments division, their appetite for risk and how they would analyze the probability of default, considering that, number one, you see, an insurance company can either invest directly through equity buying into a power plant. Now, under our current regulation, so long as it is a power plant and that is part of our, what do you call this? NEDA, 10-year development plan, it is an admissible asset already, right? You invest in that. Now we are tweaking it. Instead of investing directly, because remember the insurance companies were saying, well, most of the time, the banks go to us for equity or loan at the last minute. Before they create a project, they've already talked to huge, the bigger investors, and the insurance companies are, invited last. So, by the same token, in this case, if we tweak it and we securitize and we're looking at the cash flows, now we're saying, okay, so what is the asset here? The asset is still that power plant, but then as Stuart pointed out, we are under a waterfall, right? So the first to be paid are the debtors, right? Or the lenders. And then so where is the credit of the insurance company then? Then that will have to be looked into by our investments group and see whether that risk, has mitigants in it, because you can structure the securitization in ways that you can mitigate certain risks so that its rating can be lifted up, a notch or two higher. So a lot of the nitty-gritties will have to be looked into, but definitely securitization as an alternative form of investment would be, a welcome to not only for IC and I think, but to the industry. But we'll have to do a lot of homework on this.
Okay, so please take note of that, Milo, Art, and Stuart. Yes, Stuart, yes.
Okay, I think that that contribution was extremely good and accurate. I'd like to just point out that within the securitization process, certain credit enhancements are built into the structure to ensure that the credit rating reflects a thorough understanding of the cash flows coming all the way through the structure. In other words, the credit rating, which I think would be done by Phil Ratings or the other local, I can't remember the name, I think there's two, but would be local credit rating agencies. Yes. Crisp indeed. So we would be asking the insurance companies and the regulators to examine the credit ratings that were awarded by the ratings companies. Now, I'd also like to mention that we are briefing the SEC, who actually were the ones who asked us originally to start this whole process of private sector securitizations, and also the BSP that have the same questions to do with transparency, understanding of the structural process and the underlying assets, and understanding the credit rating risks. What we're trying to do is to introduce a little higher risk, but with a much higher yield, and that obviously has to be accepted by the investor. So this is an education process, but we believe that the securitization process itself will be able to answer all of the questions that are being asked of it. So it should be transparent to everybody, and the risks mitigated to the extent possible.
Okay. By the way, Art, do you agree government yields are actually 1% or less than 1%?
In real terms, yes, because as rightly pointed out in the slides, it's just almost 4%. So if you factor in inflation, then definitely in real terms, it's much lower. But if I may just also add, I fully agree to the points raised by DepCom Bong. But if I may also add, because I think that's those are the points raised upon inception, right? But as long as it's in the book, suppose we allow it as one of the admitted assets, how do you value it now? Because as long as it stays in the book of the insurance companies, it has to be valued from time to time. And as even for government securities, there's very limited liquidity for longer tenured assets. How much more for these asset-backed securities? Because as you mentioned, this is really for the type of investors that their investment horizon is for the long term. So how do you, will this be listed? I don't know if there will be market makers for this one that will show up prices for these securities. But given the target investors for this one, this will really be kept in the books of those investors. And how will it be valued as long as the security is hasn't matured yet?
Okay. That's a very good question. What we would anticipate initially is over-the-counter issuance, so SEC exempt issuances. I can foresee quite soon, once there becomes a sort of critical mass of these securities, that we could then list them. So you have a sort of market-based price discovery. But initially they will be over the counter. Now, we further anticipate that the bonds would be amortizing. So there would be a sort of a regular opportunity to value the bonds because they are amortizing, and you're not looking at sort of very long-term valuations of cash flow. So there's a bit more information available to do valuations. But in terms of price discovery, we would go through the usual sort of underwriting process in order to find a price that produces a market-based yield, and then sell over the counter. And I should say at this point, what we're looking to do is to sort of focus everyone's attention and answer a lot of these concerns by asking the insurance companies to give us a budget. So we're going to go and sort of do some informal market making and ask the investor to give us a budget so that we can go and create an initial issue that will test everyone's sort of regulatory parameters, the market and the whole process. And we know that there is an appetite for probably 2 or 3 billion pesos worth of securitization immediately if we could get the regulators to sort of accept a trial process. perhaps maybe for a year or 12 or 18 months to get some asset-backed securities into the hands of the investor, and then sort of take another look, perhaps a review in about 18 months after, maybe 2 or 3 issues have been done.
Okay. Okay. Can we hear your thoughts on legal side, Randy, Deputy Escolango?
Good afternoon, Commissioner, and
Good
good afternoon, everyone. Section 204 of the Insurance Code enumerates the limits on investment on securities from A to letter I. However, there is a letter J, and it states there that such other security as may be approved by the Commissioner. This proposal from the company is not one of those enumerated in this code, but there is a letter J here that this other security may be approved by the Commissioner. So may we request the Mr.
You're in mute.
Yeah,
Mute.
we've just lost you.
Depcom Randy, unmute, please. Unmute. Yeah. Okay.
Commissioner, good afternoon. Hello,
Yes.
Yes.
can you hear me?
Yes.
As
After J.
As already mentioned, Section 204 of the Insurance Code enumerates the limits of investment on securities, and it was mentioned there from
Oh, he has frozen.
hello.
Napuputol ka, Randy, napuputol.
remove your video na lang so that we can just hear you audio. Stop video. Then audio would connect better.
Napuputol
Yeah.
ka.
Okay.
Commissioner, can you hear
Yeah.
me now?
Loud and clear. After J.
Okay, letter J states that the Commissioner may approve such other security. So even if your proposal is not one of those enumerated in Section 204, the Commissioner may allow such security. It's up to the Commissioner. So we request the company or Mr. Stewart to provide us a copy of your presentation so we can study and evaluate this proposal.
Okay, thank you for that, Randy. Very good. Thank you for that, Randy. So that settles at least initially the legal issue on this proposal.
Yes,
Anyway,
Commissioner, the Commissioner has the power to allow other securities, other than those mentioned in Section 204. A2 your Commissioner. Thank
okay,
you.
Thank you to Randy. So anyway, Stuart, we'll proceed to have this assigned to our people to study. And if there is a need, they will just get in touch with you for maybe another meeting if needed. And hopefully in the coming days, we will be conferring with each other on this proposal.
Well, thank you very much indeed. And again, I should just mention that, of course, that there are other agencies that have similar concerns. And I think that at some point that it would make sense to convene a meeting, a cross-agency meeting, perhaps with the sort of technicians initially and perhaps commissioners later, so that everyone's concerns can be addressed in a forum which I think would be helpful. What we wish to do is to go to the insurance companies, which we will do initially through the Insurance Association, and we are going to ask them to sort of express their views so that we can then present an actual transaction. And I think at that point that would also give everyone a good opportunity to evaluate a piece of business that could be done, a real transaction, and maybe that's the most effective way to get something done. But our sort of strategy, instead of going to the originators, where you get a very mixed bag of motivations and sort of transactions, we want to go to the investors, who will be the ones that will be driving the demand. We will pick up their requirements, which means working very closely with the Insurance Commission and the other regulators, and we'll be creating bespoke asset-backed securities according to the investor. And I think what that will do is to make it a lot easier for everyone to recognize the transactions as they occur, being within a sort of an identifiable scope. So instead of having this sort of kaleidoscope of securities, we're going to have a much more controlled marketplace, which is going to make it a lot easier for everybody, and we can get the volume done. And I think volume will also make it a lot easier, and the market will operate more effectively, where there's a lot of volume, and we don't have to drill down too much into each individual transaction and ask for permissions sort of every time. So we're looking for something that works at scale and is focused on the demands of the insurance companies initially, and then we can look at more market sort of based initiatives later on. For example, listing with PDS. So that's our intention.
Okay. So thank you for that. And by the way, the lead on this will be the Technical Services Group under Director Art Trinidad. Just for your information.
Okay, thank you very much. I look forward to working with Art and everybody else, and we'll have an opportunity to come back and represent our progress quite soon, I hope.
Okay, so thank you. We will now adjourn the meeting, and it was nice meeting and talking with you, Stuart and Jeffrey.
Thank you very much.
Well, good afternoon once again. Thank you.
Thank you.
Okay, thank you very much indeed.
Thank you.
Thank you.
Bye.